Welcome. My name is Kristen Oliveri, Head of Private Wealth Content for Markets Group. Today, I have the pleasure of welcoming Tommy Mays, the Managing Director and Executive Advisor of SunGate Capital, a single-family office based in Florida. Welcome, Tommy.
Thank you, Chris. It's great to be here.
Our topic today is a deep dive on direct investing and co-investment. So we'd love to hear your perspective on all. And I thought we could start out with sort of an overarching question, and that's how are family offices at large evaluating direct deals and co-investments in today's landscape?
Yeah, it's been sort of this long-held aspiration that families would figure this out in sort of a collective way and leverage off of each other. And it's never really evolved. And I think some of that is because of the way family offices inherently operate. They're sort of proprietary in nature. And so my experience has been with SunGate is that, it's gotta be something that you spend a lot of your time on. And so we have been pretty successful. Direct investing was the source of wealth, right? And so evolving that, it's been the principal's aspiration to continue down that path. And so one of the things we had several realizations back in 2019 that generated a lot of capital. And as we begun to put that to work, we realized that the diligence cycle and the sourcing of deals was, something that required a lot of attention. And where we ultimately landed is that we really have begun to favor, using independent sponsors as our, partners to create the leverage around diligence. And so generally family offices are either struggling to figure this out or have been, sort of necessarily relegated to funds and strategies. And so when I just had this conversation the other day with someone that, if you are going to go into this space, you have to go into it in a very professional way. And it's expensive, and it requires a lot of resources and a lot of commitment by the family. And so, most families have really not gone down this path except for the very, what I would call the, upper 1% of family offices, upper 10%, and the people that maybe came from this space and have a good team.
I know that you're someone who wears many hats. What does your role entail within SunGate and sort of bring that full circle into the direct deal conversation?
Sure. I come at this as sort of the generalist on the team because I can speak the governance, family dynamics language, but also can go pretty deep on the investment side. And so I try to be the bridge between the two. Ultimately guiding, the team to make sure that the things we are looking at fit the long-term mission and goals and objectives of the family, but that we are also at the same time looking at the structure of our enterprise and how we approach decision-making in an evolving way. I believe that all family enterprise offices need to evolve as the family evolves. And so it's been an important part of my role to kind of help move that along.
Yeah, absolutely. So from your perspective, how would you say you evaluate a direct deal? And if you'd like to give a specific example, that'd be great too.
Sure. Yeah. We actually are really boring. We buy EBITDA, we buy cash flow. And so, it sounds very straightforward, but we are not at all specific with regard to industry. And we have been very fortunate, particularly last year we bought either all or significant portions of 4 different businesses in 4 different industries. And they were all, cash flowing established businesses. So we look at, all the things that you would think are very important. Obviously, the company itself, the product or the service it provides, the industry that it's in, the moat that may or may not be around their industry, the core competency of the management team to continue on. And so none of these things that would surprise anyone or be particularly innovative. We do like what has been referred to as platform opportunities. in the private equity space. And so a good example is we invested last year in a company alongside an independent sponsor, very good independent sponsor, a company called Aqua Leisure. And so if you've been to Target or Walmart to buy cheap pool toys for Juliana, you would have seen Aqua Leisure. And so their core competency was, and this was perfect because it's a theme, was supply chain, was their ability to source manufacturing in the right geography and the right location at the right time. And so the idea was to take their sort of core business, which was very good, quite concentrated around their customers, Walmart, Amazon, but take that platform and then go look for other acquisitions to leverage off of their supply chain management. And so since we acquired, I think 47% or so of the company, we are a direct owner of that equity, and we have board rights and all of the rights that you might expect in our operating agreement. But we have since acquired Airhead, which is a very well-known brand in the towable space, right? Well, they were struggling with supply chain issues, as I understood it. And so, we were able to make that acquisition and see through what was really actually a fairly high valuation to the fact that we knew we could add value to their operation and really continue to improve that business. And so, and of course, we had the rights to maintain our equity level. And so we increased our equity investment in Aqua Leisure to support the acquisition. And so that's a platform for us. So we've done the diligence on the management team, we've done the diligence on the sponsor, we've done the diligence on the broader aspects of the business, and we can just keep adding money to that investment as the opportunity presents itself.
Oh, that's fascinating. Are there any other type of specific industries that you find yourself going back to over and over? Are there a couple that you like the best?
No, not really. I would say that as you know, our primary business was public for-profit education. And so we find ourselves looking at opportunities that sort of are tangential to that. Really haven't, pulled the trigger on any. We were close on one and we just found some issues and we backed away. But the other thing that we do have is a pretty significant core competency in the medical space, particularly where you've got payments coming from insurers and Medicare. And so we sold what was then probably the fourth or fifth largest privately owned medical imaging company in the country in 2019. That was the source of some of these proceeds we've been investing. And so the founder CEO of that company has begun to invest alongside SunGate. And then also the CFO and one of their senior finance people has joined SunGate Capital. And so we brought in that core competency, we brought in all that capacity. And so that's really what's allowed us to ramp up our investing. And so we perceive that, from time to time, we will see opportunities that elaborate on that expertise. We did make an investment in a podiatry roll-up, so an acquisition rolling up podiatry doctors, which is one of the more what I would call boring and straightforward aspects of medicine. But we, small investment, but again, we invested in a group that we believed in, an independent sponsor. We invested in the first acquisition or two, and then every time they make another acquisition, we're in there with them, evaluating and sort of having a voting role in the process, but we also get to stack capital. And so that's probably the one where we've been the most focused from a core competency standpoint, is in the medical space.
Oh, that's really interesting. So obviously this isn't your first rodeo. You've had lots of experience in direct investing. So I'm sure you've learned a lot of hard lessons. There's been some missteps and lessons learned. Anything you want to share about what not to do or things to look out for that in your experience?
So there are a couple of rules, and the first one is so obvious, but it needs to be said, and that is get to know fast. Assess a situation, determine whether it's got the attributes that you need to even make it remotely successful, determine if it fits sort of some of your broad and more important core philosophies. So for us, definable EBITDA, nice growth trajectory, and what we perceive to be a valuation we could get our arms around versus one that's got this, fantastical valuation and whatever. So that's like a primary filter for us. So getting to know fast is really important. I think I see families often will get enamored. It's kind of like car shopping, once the salesman realizes you're in love with the car, you're in trouble. You lose your negotiating skills. So being disciplined around how you're developing your due diligence file, being disciplined around how you interview all the various participants has been something that I think we found to be valuable. I've seen that mistake happen. You get excited. I mean, I'm an optimistic person, and so I'm actually the one on the team that's most likely to get excited about something that's really interesting, or a strategy, or a company that I think has lots of potential. So having balance, having multiple voices, having constructive conflict on the investment committee, all those things kind of tie into that one concept. So, and then the third thing I think that I would recommend, that I believe we've done well, is to seek outside resources, consultants, advisors, due diligence partners beyond the independent sponsor that can come in with specific industry expertise. We have been looking for a long time. We just haven't gotten to a place where they needed the money, but we've been looking at a pet. It's not food, it's things like the chewables and all those things, but it's all really, it's a fast growing business, right? But we didn't know anything about this business. So we found a consultant that came alongside and helped us with the due diligence. We're also looking at an organic dairy in Texas. And
interesting. Okay.
Yeah. And so we found, not only did we find a farmer or a former farmer that's, willing to dive in and not only invest alongside us, but maybe run it if we proceed with the investment. But those types of things, I would say, getting to know fast, being really disciplined and patient with your diligence, and then, bringing in outside expertise where it's needed are three things I would highly recommend.
It's amazing advice. So once you've made an investment, what's your experience been working with companies after that? Walk me through what that involvement looks like. How involved are you?
Yeah, we have a variety of scenarios. So, and a lot of it has to do with the age and stage of the company. It has to do with, what our level of capital is. But, today, the modern version, the more contemporary version of that answer is one or two board seats, very active in terms of communicating both with the sponsor and often the management team to the extent that we can add value. I think that's where our principal is most gifted, is getting in and rolling up sleeves and getting with the management team and really helping them solve problems and pursue opportunities. And so that's sort of the, today how we get to that is sort of through that board seat and then through some of our rights through our operating agreements. And so that's how that looks like. On the other end of the spectrum, we've got companies that we founded and so or helped found. And so, those may be even more accurate. And an example of that is we own a majority stake in a specialty life insurance carrier. It's a private placement life insurance company called Investors Preferred. It is, we are the enterprise is a very large customer because we're a big believer in the structure from a wealth planning perspective. And because of my background, I got involved in that early on when I joined SunGate, because it's a wealth management structure for particularly for families and family wealth, and so multi-generational family wealth. And so I started out on the board, got very involved with the management team in terms of strategy and tactics. And then when we decided to really lean into the company and grow it more rapidly and really try to elaborate on the market opportunity we saw, I actually stepped in as an operating member of the team and
Oh, wow.
exist as president of the company right now. And so that's been a lot of fun. And we have doubled the size of the company in the last couple of years. And we're seeing tons and tons of opportunity. We've added staff. And so that's sort of an extreme example of the SunGate involvement of a company. So both ends of the spectrum.
Oh, yeah, that's amazing. And you've been very kind, giving some really granular examples of some of the opportunities you're seeing. Yeah. Anything else we're missing? Where are the opportunities you're seeing today, maybe in different sectors that you're excited about or at least intrigued by?
I think the from an investment standpoint, this may surprise you given my age, but I have been in a deep dive in the digital asset space and spending a lot of time. I live in Winter Park, as you know, near Orlando, and there's a significant presence in this area. I don't know why, but there's a lot of really interesting firms that are here and people that are here that are knowledgeable in the space. That's been really helpful. And so when I say digital assets, what I'm really talking about is sort of the venture side of crypto, where a lot of these tokenized assets are essentially equity representation of the underlying protocol and technology. And so I've actually got a friend that's just, he's a technologist in his own way and by experience, and he can explain exactly why one protocol is better than the other. And so that's been something that I personally have been very excited about. What I know in the family office space is, and I experienced this at the meeting I was just at in Atlanta, that it's sort of a 2% of the family office space is really thinking about this right now.
That's interesting. I would have thought more.
What's that?
I would have thought more, but
yeah, well, and it may be the wrong sample too, right? I only know what I've seen, but I think that when you look at what's happened since the mid 90s, and you think about Web 1, Web 2, and now Web 3, the digitization of everything, all of this that's going on will inevitably be necessary to support Web 3. And the great thing about it is that this space has significantly institutionalized in terms of the quality of what's available, in terms of advice and custody and security. It's significantly institutionalized over the last 12 or 18 months. And so when you start looking, it's almost stunning what's out there and what's available and what the possibilities are. But it's venture capital, so you've got to want to go there.
Got to want to be in it, yeah. I could see that.
Yeah.
So you touched upon it earlier, but I feel like we can never have a conversation about family offices if we don't talk about governance. What types of governance structures does SunGate have in place? And tell me how that sort of fits into the big picture.
Sure. Like a lot of family enterprises that are still led by the principal, by the founder, by the G1, a lot of what we have in place, it has been formative and in some cases sort of rehearsing for that more formal future that's coming, right? And so I give example of, we started a rigorous discussion around our investments. We call it the investment committee. It's very informal from a voting standpoint, but yet it's how we build consensus around investment ideas, both on the public and the private market side. We have on the family side, I call it the family board meeting, but it's board with a small b right now. It is a monthly meeting with the G1 and the G2, and I facilitate a combination of discussion amongst family around important family issues, but also for SunGate to have a venue to come in and report on what all's going on in the enterprise, both from a balance sheet perspective and a cash flow and profitability perspective, but also, from what we're looking at from an investment perspective and getting their thoughts and opinions about things. And so those are what I would call informal structures. I call it the rehearsing for the future, right? And so, but at the same time, we're in the process. We've chartered the trust company, but we're in the process of inserting a private family trust company into the governance structure. And that will actually formalize some of these things that we've been rehearsing for the last number of years. And it, just by nature, a trust company requires a board of directors. It requires an investment committee. It requires a distribution committee. It requires certain things from a regulatory standpoint that create the rigor around a true family governance structure. I still believe, and a lot of people believe this with me, that the private trust company, while it's somewhat intimidating and it has a lot of structure to it, is still state of the art in terms of providing families a sustainable long-term structure for living through multiple generations. If the family aspires to that, not all families aspire to that, but if you're an aspirational family enterprise, it's still one of the best structures.
Agreed. And so we're in 2022. Are there any types of specific regulations that you as a family office should pay special attention to today?
Well, that's something that came up again this week too. I was actually talking to the former head of Fidelity Family Office yesterday about this. Family offices still enjoy the family office exemption from the SEC registration. The fact that a number of enterprises, and most of them in the hedge fund world, are sort of abusing that definition to a certain extent, are causing it to continually get scrutiny. And so it's possible that the SEC could come along and offer much stricter parameters for that exemption, and it might even cause some existing family offices today to have to register. The gentleman I was talking to and I both agreed that I don't think that would be all bad. Now, he and I have a lot of experience in the registered space, and so we understand the implications, and it's not as intimidating as it would be for a private family. But what I would also say is, back to the earlier point, is that a private family trust company is naturally exempt. It is part of the envelope that would keep the privacy in place. And so I think that's probably the number one thing that we would see. One of the things with co-investing, club deals, things like that, is you can find yourself in the position of being an investment manager for non-family members or non-exempt people. So there's other exemptions, executives of the family office and things like that. You could find yourself in the position of being a manager, being a discretionary manager, and be in violation without even really knowing it. So those things all kind of tie together to say that you need to be thinking about, where you sit. There's ways around it. There are all the hedge fund, there's 3C1, 3C7, there's all these, exemptions that you can file for to avoid, the full reporting, but then that requires a more formal structure, offering memorandums and all those things. So those are the things that I would be constantly on the lookout for, particularly if you're active in the direct and co-investment space.
Right. So it's something of the conversation that needs to be had. So before we wrap up today, Tommy, I'd like to hear a little bit about you. I know you and I have known each other for quite some time, but walk us through a little bit about what your professional background looks like. I know you are a true Renaissance person. And tell us about how you found your way into the family office space, because it's never a very clear line how people find themselves working for family offices.
Well, you're right, because there's no training program per se. So I've been in the professional world for almost 34 years. The first 20 or so of those were in the environment of a commercial bank. Almost all of that time I was in what was early on called private banking and later called wealth management. And I spent 10 of those years, but unbelievably, because I'm a farm boy from North Carolina, but unbelievably, I spent 10 of those years in Palm Beach, Florida. And so I began to get exposure to family offices. I didn't really realize some of them were family offices because I didn't know what the expression meant back in the mid 2000s. But, I found that there were families that had these formal offices, teams of people that were managing their affairs, and found them to be very good clients and very good people to try to work with, at least in very specific ways. Along the way, I convinced a firm that I was working for at the time. We had a multifamily office operation embedded in the private bank that was very successful. And so I convinced the firm to open an office of that group in Palm Beach. I helped see the office and ultimately ran the office for a number of years. And I started going to family office conferences, and I went to Fox and I went to IPI, and I kept meeting these people that were, I guess, my age now, who were really loving the work they were doing, helping families work through the issues of in some cases, significant wealth. I think what we call significant wealth 20 years ago is a little different today. But I thought to myself, even then, I'm like, maybe that's what I want to do when I retire from banking. And then the great financial crisis came along. And so I kind of had my hand called because it was really traumatic. The bank that I worked for at the time ended up being sort of handed to Wells Fargo. It was de facto failure. It was financially challenging for me and my family. And so I was really fortunate. I reached out to some mentors and said, I really think that I'd like to give my hand at a family office operation, and was introduced to a very cool family in Greensboro, North Carolina, that the goose that laid the golden egg for them was Vicks Vapor Rub, of all things. And so really interesting family, 6 generations, 400 living family members, 100 households. It looked like a multifamily office. And so for me, that was an easy transition because I understood where they were in their evolution. And we had a private trust company. I set up an RIA to the side to manage non-legacy family capital. Really great opportunity to, round out my experience. And I worked with him for about 5 years. And then we agreed to move on from each other for a variety of reasons. But I found my way to, sort of a bifurcated world where I'm now an investor in wealth management and asset management firms because of what I learned at Piedmont Trust Company, but then also was reintroduced to what was a prospective client when I was in Palm Beach, the principal of SunGate Capital. And I thought I was going to spend a year with him doing some consulting and setting up a trust company. And here we are 7 or 8 years later. And it's been, I think, a symbiotic relationship for all of us. But along the way, I've made great friends in the space like you. And that's one of my favorite things about the family office world is the community of it and the diversity of it in terms of the things you can learn and experience and see. And so today, I'm really enjoying helping this G1 principal envision what his world looks like when he's been promoted to heaven, and there are multiple generations of his family living under this governance structure that I'm able to help him design.
Yeah, and the neat thing about what you do is you're really making an impact in a family's life, their life cycle, and their future legacy, which has to be a really cool feeling at the end of the day.
I hope so.
I'm sure you are. Well, Tommy, thank you. That's it for me. Thank you for being so thoughtful with your responses and giving us sort of a roadmap on how to evaluate direct deals and things to look out for, challenges and opportunities. So thank you very much, Tommy, for joining us today.
It's my pleasure, Kristen. Great to be with you. Thank you.
Thank you.